The mortgage process. It can be the most exciting time of your life where you're closing on your dream home, or it can be the most stressful time where document after document or just issue after issue comes up. It's one or the others. And in this video, we're going to go over 5 different things to avoid. So that way you know exactly what you need to have the most seamless, stressless mortgage experience possible. We're going to go over why pre-approval and getting it early is important. Understanding closing costs. It's not just your down payment. There's a few other things to consider, and most people don't realize that. Overextending your budget. It's a slippery slope when it comes to buying a home. Just a little bit extra, $10,000 here and $10,000 there, your payment will creep up, and you don't want to go down that road if you can't afford it. So then skipping inspections like home inspections and waiving that on your contract. And last, focusing on just the interest rates. Rates are like gas prices. They go up and down. Choosing the best option at the time where you find the home you love is important. But again, we'll get into all this here shortly. My name is Dan Friel. I'm a mortgage loan officer with Barrett Financial Group. Let's dive in. So first, let's go over why not getting pre-approved early can be a big issue. The biggest thing is most people don't know what they can afford. They have an idea, but they don't have an actual pre-approval before they start looking for homes. They're on Zillow, Redfin, Realtor.com, spending all this time driving around. But once the rubber meets the road, they say, okay, we want to put an offer in, or worst case, we already put an offer in before we got pre-approved with a loan officer. Sometimes their dreams can come crashing down. So first step, as you're getting interested in looking for homes, get pre-approved. It's free. Me personally, I start with a soft credit check, so it has no impact. You have no skin in the game. Again, it does not cost you any money, and it's an important step to make sure that you know exactly what you can afford so you can use your time usefully and accurately and find your dream home and get to work. So what does a pre-approval look like? What is even a pre-approval if you're just getting started? And I'll pull that up here. This is, for most of you in the United States, what a pre-approval is going to look like. It's basically a letter from me as your loan officer, and it says, hey, I've looked at your finances, your credit, your assets, your income. I believe that you can afford whatever home that you're looking for in this price range with this down payment, with any necessary seller credits and any necessary earnest money deposit. So as you see here, you also have a date. Usually pre-approvals last for 90 days. And again, you'll get this after you fill the initial application out. You finish that, and then I'll ask for a few documents such as pay stubs, W-2s, driver's license, any other mortgage statements or homeowners insurance policies on any other homes that you own. My job is to figure out a snapshot of your financial situation so we can get your debt to income ratio, the loan to value, and things like that to qualify you for the home so there's no surprises during the process. So it's less stressful, or hopefully stress-free. So getting all this set up front makes you know where you're going so you don't end up someplace else. So again, this is what it looks like here. It'll have a date, and it'll have the area, usually the zip code, and the town or the city that you're looking to buy. And then the expiration date, usually 90 days. The reason why most pre-approvals are 90 days or less is because a lot of times the credit report or the soft credit report really only lasts for that long, and every 90 days you should refresh it and recheck to make sure there's no big changes that can throw you out of your qualification for your house. So 90 days is the rule of thumb. And if you go down a bit, you'll see the purchase price. In this case, we're going to use $400,000 for the home value, and a loan amount up to $388,000. So what this means is you as the buyer are looking to put 3% down on a conventional loan on a 30-year term. You'll see all that information here. And for first-time home buyers, you can put as little down as 3% on a conventional home. If you want FHA, it would be 3.5%. And if you absolutely need it, there's down payment assistance programs where you can go and ask for a grant or a different assistance to help that gap of, if you don't have 3%, you can do it, but there's never any free lunch. So you kind of pay for that in your rate, extra fees, and so forth. So having a loan officer that understands your specific financial situation, that can guide you in the right area, is the most important. But this is pretty much what a pre-approval looks like. It's very simple. It's mainly for your realtor. Most realtors will drag their feet working for you before they have this in their hand, because again, a lot of people want to look at houses, and it's a lot of time on the realtor's part to show you houses, and this shows or gives you a good promise of, hey, we can get a mortgage and we can close on this home if we like something and want to put an offer in. And next, I want to go over understanding the closing costs, because everyone thinks down payment's all the closing costs. That's really the mainstream thought, where you need 3%, 20%, and so forth for the down payment. Honestly, that's where it begins. So let's jump over to that. I'll show you an initial fee worksheet I just worked up. And this is based off today's market. So it's November 19th, 2024. A general rate for a credit score of 740 on a conventional loan, 30-year fixed rate mortgage is going to be right around like 6.375-ish, right around there. So that's the rate I chose for this. This is in Arizona. I'm based here for this quote. But you'll see that the down here, and this is the 3% down payment example still. We're gonna ride that for a little bit here. But on a $400,000 purchase price, which is up here, your down payment, which is 3% of that, is $12,000. But that's not where it ends. If you look at your estimated cash from borrower, which is you as the buyer, you're gonna have to come to the closing table with $21,549. So where does that difference come? Because that can be a big surprise for most first-time home buyers or buyers in general that haven't really bought a home in a while. The main aspects that make up your closing costs are your lender fees, which are things like points, underwriting fees, admin fees, processing fees, things like that. That's what your lender or me as your mortgage broker have full control over, and we can look at your options and put you in a right area that works best for you. But there's also other things that are added out of our control. Property taxes, homeowners insurance, and title fees are the big three, in addition to your down payment and lender fees if there are any. So if we look at our initial fee worksheet here, the lender fees are just a lender admin fee. This is generally an underwriting fee. Every lender you look for or you look at will have a different admin or underwriting fee, and it's either built into the points or taken out. What I like to do is I like to show you on paper right here that, hey, this is where it is. Many loan officers or brokers will hide it in the points, but I like to kind of show exactly what's going on so you can learn and be educated. And then in this market, with rates anticipated to come down the next 12 months maybe, I mean, most people have been wrong, but I do believe in the next 12 months rates should start settling down a bit. A refi will probably come in the forecast there. So spending a lot of money on buying your interest rate, which kind of correlates with points, doesn't make a ton of sense, because the difference in your monthly payment versus the cost usually doesn't pay off in 12 months. So my main recommendation is 0 points, as cheap of a loan as possible, because the loan's not going to last you very long if rates go down, which the likelihood they are high. Next, if we look down here at third-party fees, so you'll see services you cannot shop for. And that's the big term here, is services you cannot shop for and services you can shop for. So starting with services you cannot shop for are appraisal fee. Those are deemed by the appraiser. Third party, very separate from your loan officer or lender, because that's the value of the home. There can be no working in cahoots on that. It's usually through an appraisal management company that we work with that connect everyone together. But your appraisal fees are pretty much along the same line or the same fees, depending on the county and the state. They usually don't fluctuate too much. In Arizona, $700 is a good quote, $700 to $800, around there. That's usually paid outside of closing, so debit or credit card usually while you're in the mortgage process. You get that rolling. So you won't see that in your estimated cash to close of $21,549, because you'll see right here, total credits applied paid outside of closing, $700. That's that appraisal. Some options you can get it rolled into the loan, but most of the time I prepare that you do not prepare to roll it into the loan. Next is your credit report fee. So when I do pull a regular credit report, it costs a fee. I generally don't charge up front on that, but you will pay for that on your closing documents in your cash to close. A single credit report for a single person is right around $70 these days. And then the flood certification fee, that's if you're in a flood zone or not, but it's on here for just proof of concept. You usually will see these three things in services you cannot shop for. Next is services you can shop for, which is basically title fees, title companies. You're not married to the title company that your realtor or the person that you're working with recommends, but you can shop around. Title companies will have higher or lower rates depending on who you're with. So it's important to have a good relationship with your realtor and your loan officer and see what the kind of fees are out there. Usually, whatever your realtor or loan officer sets you up with is generally a good bet, but you do not have to go that route. You can always shop around if you need. But that's the big one is in this scenario, these fees for title, which is title insurance, settlement fees, and verification of employment and things like that, those are going to be baked in, and that's a cash to close increase for you. So you got your services you cannot shop for and services you can shop for right here in third-party fees. And that's $6,000 in our example for a $400,000 home. Then next, you have taxes and other government fees. In Arizona, they're pretty cheap. Usually it's just a recording fee. 60-ish bucks, right around there is what we see. But if you're in a state like Pennsylvania, it can be anywhere from 2% in a transfer tax of the purchase price. So again, it's important to know exactly what you're dealing with before you go and actually actively look at homes. Your loan officer or mortgage broker should be able to tell you, okay, this is what your expectation for cash to close is, because you don't want it to be a surprise. This is the last section of the industry that you want a surprise in is your mortgage, so know where you're going up front. And then here in the last few parts, prepaids and initial escrow payment at closing. So prepaids are your homeowner's insurance. You can either pay that outside of closing, so before you close, or you can roll it into your closing costs. In our example, and for most people, they roll it into the final cash to close or your closing costs. I'm guessing in Arizona for this property, it's going to be $150 a month for your homeowner's insurance. That's something the buyer takes care of and gets quotes and decides and then gives me the policy information to confirm, but something you shop for. But usually in this price range, $150 is probably on the top side. My personal home is right around $100 a month. So you'll be anywhere in that range here. And then prepaid interest. So this is actually a little tip. Prepaid interest depends on when you close in the month. So for example, if you close on the first of the month and you own the home from day 2 all the way to the last day of the month, so you basically own it for almost every day except one, you have to pay for those days. So that's called prepaid interest. However, if you plan to close on the last day of the month, you have to pay for only that one last day of prepaid interest. And that prepaid interest adds to your cash to close. So if you have an early in the month closing, that will increase your cash to close. And if you have a very late in the month closing, that will decrease within margin, right? There is little tricks you can do in the first 7 days of the month to play with the numbers a little bit, and I can help you with that. But that's another cost that people don't realize is where you close inside the month can increase or decrease your cash to close. And then your initial escrow payment at closing. So if you are required or if you opt in to have an escrow account, which pays your property taxes and homeowner's insurance every month inside your mortgage payment, so you don't have to worry about paying the county for your property taxes and the insurance company once or multiple times a year. And again, that doesn't cost you anything. I recommend it. That has to be built as well. So in our example here, your insurance reserve, where we are in the year, it's November, they'll probably require 3 months of your insurance reserve, which will be $450. And then your property taxes, 3 months, because again, it's November, of $750. And I'm guessing property taxes in Phoenix, $250 a month. High side probably, but I always like to round up worst case. That way it gives you a good idea of this is where you'll be, and it'll probably boil down and be a pleasant surprise, but this is what I would expect for your escrow account to build it, because the way the escrow account works is it builds over time. You add to it every single month, and then when property taxes are due, it pays out. When homeowner's insurance is due, it pays out. So that's all you're doing is it's your money, and legally they can't have an excess of $50 in that account. And if they do, you'll get a check in the mail. So it's a free thing, doesn't cost you anything. I recommend it. FHA loans, VA loans, Kind of points you at getting an escrow account more than conventional. But again, it's something you can discuss and figure out your options when the time's right. But if you go down to your estimated funds to close, you'll see all this broken down. So your down payment of 3% on $400,000 is $12,000. Lender fees in this area here, it's again, admin fee, underwriting fee, kind of all the same thing. Depends on the lender or the bank that you use, what their cost is. But $1095 is when I quickly priced this thing out. That's, I think it was Windsor Mortgage was fee that I put in here. Third-party fees, this is your title fees mainly, and then credit report fees, but mainly made up of your title fees here. Next is taxes and other government fees. So this is just the recording fee, prepaids, and initial escrow. Again, that's your hazard insurance premium, your homeowner's insurance that you get for the subject property, added to your escrow account, which is your 3 months of homeowner's insurance, 3 months of property taxes. So when it's due the following year, that account's full and it can be paid, and you don't have to worry about it. And also your prepaid interest, which in this case, I'm going to close you in the last day of the month in this example. So you have 1 day, which is $67. That'll adds up to $3,000. And total funds due from borrower is $22,249. But then you paid one thing outside of closing, which was that appraisal. So subtract that. And again, this is your cash to close. So main takeaway here, your closing costs are not just your down payment. It's down payment plus any lender fees if applicable, third-party fees, which is title, taxes, and insurance. And then in some states, more common than not, there's transfer taxes and other fees that you have to consider as well. Just legally, you have to pay those when you buy a home. So it's not just down payment. Let's jump into people overextending their budget. It's a slippery slope. And you look at houses and you're going, oh, 10 grand here, it's 400,000 was my budget, 410. That's not a big jump. In reality, every $10,000 you finance, all things consistent, is about $60 extra a month in your payment. So let's go over what that looks like on paper. Let's do the math here. So at a interest rate of a 6.375 for this example, conventional loan, 30-year fixed rate mortgage, a $400,000 purchase price, 3% down for first-time homebuyers, your payment's going to be right around $3,000 a month. And this is, I think, a very conservative homeowner's insurance quote and a very conservative tax quote. It's probably going to be a bit lower, but just be conservative in my numbers here. I don't like things to go up, so they'll probably get better. And then you have PMI, which we just discussed. But this is the payment to kind of look for in this type of purchase price or range here. But let's go over, okay, what does 410 for the purchase price look like? There we go. So we got 410, 3% down. Everything else looks good. And that will change your mortgage payment from $3,000 a month to $3,076. And that error there is I don't have first time home buyer checked. So my computer is like, hey, this program's not valid, but for this example, it's fine. So again, $60 a month, $10,000 change in your loan amount, $60 a month difference. So then it's a slippery slope, right? You're like $60, that's like a dinner, right? But if you jump up from 400 to 450, let's do that. To hit save, the arrow will pop up. So just anticipate that. 1 second here. Oh, all right. So 450, 3% down. Now look at your payment, $3,337 a month. So it went up $337 a month, just about, with a $50,000 price jump. And that's a game a lot of buyers will play without telling their loan officer. For my standard operating procedures, what I say is, if you love a home and you're like, hey, we're pretty interested in this place, text me the address, I'll quickly price it out, and I'll spit out payments, cash to close, and so forth, so you know exactly what you're getting into. That way, you go to the house, you say, this is going to cost this much. How does this feel? Does it feel right? And then you can make the choice from there. Again, minimizing these surprises is the whole name of the game here, to keep it as stress-free as possible. So that is the overextending of their budget. Pretty quick and easy, but you have to be careful because it's always easy to fall in love. The more expensive the home, the nicer it is. And you're like, oh, I can kind of stretch and reach and stretch, and you don't want to be maxed out on your qualification because one weird thing happens in process and it could jeopardize the loan. So that's why you want to get these things priced out, payments, cash to close, everything before you go ahead and put an offer in on the home. And next is just details like skipping home inspections or waiving appraisal contingencies and things like that on the contract. What that means is sometimes people love homes so much, and if it's a competitive market, otherwise known as a seller's market where they have the power, there's a lot of buyers, a lot of interest, where you have to set yourself apart, realtors will tell you to waive inspections, waive home appraisals, and yes, you can do it. Sometimes that's the right thing to do to get the home that you love, but there's risks. If you waive home inspections and you go under contract on a home and that offer accepted, and an inspector goes out and says, hey, this thing's full with termites, that might not be a good enough reason if you waive the homeowner's inspection contingency on the contract to back out. You might lose your earnest, which a lot of times is 1% of that purchase price. In this case, be $4,000 or $4,500, depending on if it's $400,000 for the purchase price or $450,000. A lot of money to lose out on. Or if you waive the appraisal. So an appraisal is a third party, which is the appraiser, checking the value of your home to make sure it's a good buy. So it's in your best interest. All these steps during the loan process is to protect you. So when you go under contract on a home, you get that thing appraised. Let's say you paid $400 on the contract, it appraises for $385. So you're $15,000 low. What happens then? You have to come up with that difference. Or you can renegotiate with the seller, but if you waive appraisal contingencies to renegotiate, you might be in a bind. You might have your earnest money jeopardized. So it's really important to use your resources, inspections, appraisals. They're only to protect you. So something to think about. Last here, this is what I deal with most often is hyper focusing on interest rates instead of the full loan terms. Interest rates are like gas prices. They every day, sometimes multiple times a day, they go up and down, they move around. The federal government changes their Fed interest rate, which may affect your mortgage interest rate as you're getting quotes from different lenders. So it's just a beast that keeps on changing. And generally, what I always recommend to people is figure out what the cheapest option is within reason. So as a broker, I have 160 different options we can price out. We can go over pros and cons of each option. The rate's usually generally not the biggest concern, but some people hyper focus on rates and they chase. And in reality, how long is that rate going to last? Is it going to last you 12 months? Is there an anticipation that rates are going to come down the next year or 2 years? Getting your home that you love is the most important. You can miss out on that. You can always set yourself up to refinance later too. So don't miss out on the home. You can, in many cases, refinance. And worst case, if rates do not come down, make sure your mortgage is within your range because there's no certainty in mortgages. Rates may continue to go up forever. They may continue to go down and back up and so forth. So right now is what we have control over. Figure out the best option that works for you. Figure out a good team that's going to set you up for success and has the knowledge that can not only just jam you into a refi, but explain pros and cons of everything. Because sometimes when you start a refinance or you do a refinance, the loan term starts over in most cases, and then your interest starts over, and interest is front end loaded. So it's a complicated beast, and your loan officer should be able to take care of you and lead you in the right direction. So hyper focus on interest rates right here and now. There's a time and place, but in this market, just make sure that you love the home, your option's good, and you're not getting highway robbed or you're not suffering from highway robbery from your loan officer because sometimes you can be overcharged, but it's really payment. Is the payment comfortable with you? Are the terms okay? And what's our plan for the future? How long are you going to stay in the home? And it makes no sense to pay a bunch of money and buy the interest rate down with a bunch of points if you're not going to be there for too long or the loan's not going to last you too long. And that's really it. That's all I got for you today was those 5 things. We went over not getting pre-approved early, big mistake, and now you know what a pre-approval is if you didn't already. Underestimating closing costs. It's not just your down payment. It's down payment plus title, taxes, insurance, and sometimes more. So figuring out exactly what that expectation is going to be a super helpful thing for you moving forward. And then overextending your budget. Nice homes cost more. It's a slippery slope. 5, 10, 15 grand here or there can really make your payment go up, and you don't want to be surprised. So get a quote for every home that you love that you're really interested in by your loan officer or broker. And skipping inspections. That's a big one that can produce a lot of risk for you in the mortgage process, where if something doesn't work out, the home's not worth it, you could lose your earnest or jeopardize that. And last, focusing on those interest rates or hyper-focusing on them. They are important. That's the fee that you have to pay to borrow the money from the bank or the lender. But generally, they're pretty consistent as long as you're not getting overcharged by like the big retail establishments. If you have a broker and you have your pricing and you have your options, you should be put in a pretty good space. Just make sure you trust your team. I'm Dan Friel. I am with Barrett Financial Group. If you have any questions at all, my email, website, phone number is all in the description. I'm here to help. I want to make you a smarter, more thoughtful buyer to keep this as less stressful or as least stressful as possible, if that's the right way to say it. Have a good one.